Did you see those headlines saying that the markets are worried about the increase in job losses? Or the big drop we saw in the markets because investors are worried about a recession? Well, if I gave you $1 for every time somebody said we're going to enter a recession in the last 3 years, you'd all be rich by now. But the truth is that it's just not as simple as a jobless claims data report. If you're wondering what the heck is going on in the markets, why they're afraid of a possible recession, and how you can take advantage of it, you need to watch this entire video. And heads up, I won't be selling you a how to get rich course. I'm making this video for you to understand what's actually going on so you can take advantage of the opportunities to trade when they come. What's up, guys? My name is Josh Faveo, and I hope you're having a profitable day. And since you came here because you want to know whether or not we're in a recession, I know that you care about understanding the markets. But before getting into the charts, you need to know that a big rise in people claiming for unemployment benefits increases the odds that the Federal Reserve is going to cut interest rates. That's because it indicates that fewer people are employed, which means the economy is slowing down. In other words, consumers are spending less, which slows down the economy growth. So in response to this economic slowdown, the Federal Reserve might respond by cutting rates in order to stimulate the economy.
Yes.
But don't get so excited yet, because even though lower interest rates makes borrowing cheaper, which helps businesses grow and helps consumers want to spend more money on things like cars and houses, this can also be a sign of things getting bad. A significant rise in unemployment shows us that jobs are just slowing down their hiring. And those people who are now out of jobs also cut back on spending. With less spending, the overall economic output can decline, which can turn into a recession if this continues. So what was the reaction of the markets to unemployment going up? Let's break it down on the charts. So everything started right here where we have the economic data that came out on Thursday. If we take a look here at jobless claims, you can see that the expectation was 236,000, but we ended up getting the actual 250,000. This is the first sign where we have jobless claims coming out above expected. This is the first sign of the labor market slowing down. The reason why they think that this number is a sign of showing an economic slowdown is because this is literally telling us the amount of people that are claiming unemployment benefits. So when we have an expectation of 236, we came out with 14,000 more people just this week that the markets were expecting for claiming unemployment benefits. So we have more people than expected who are out of work. Now, that wasn't the only thing that happened that day. If we take a look here, you see something called ISM Manufacturing PMI. PMI data is just an economic indicator that's measured from a scale of 0 to 100, and this tells us how strong the manufacturing industry is, right? Simple enough, that's all this is. Now, 50 is the median point. Anything below 50 is considered to be a contractionary environment. So what that means is if we get a print below 50, it's bad, right? So enough said, that's what that means. So now when you combine these two pieces of data, think about this. We have jobless claims, a lot of people out of work, right? The second thing, we're seeing a slowdown in the manufacturing industry. Both these pieces of data are telling us that there is a slowdown in the economy and that the Fed's holding interest rates high is actually potentially pushing us into a recession. Look at the time that this came out. The last piece of data came out, now this is Eastern time, 10 o'clock a.m. Eastern time. If I move this little calendar off the screen for now and you take a look at the time here, look at the bottom, you can see that this move right here, I'll circle NASDAQ, that move correlates right here with 10 o'clock, right there, right? So you can see as soon as the data came out, we got this gave us what's called a risk off market, which is market fear. Market fear is usually when this happens, things in the markets that are considered risk assets, NAS 100 being that exact thing. This is why we ended up selling off, breaking support here, and taking sells pretty much for the rest of the week because the markets were now thinking that we have a recession coming. And it was all based on the exact same data that I just showed you that came out earlier. We have higher jobless claims and lower PMI data coming out. This caused the markets to believe that the Feds need to start cutting rates early or else they're going to push the US into a recession. So as you can see, the first piece of data, it didn't come out that bad, which was the jobless claims. NASDAQ didn't even drop immediately. It actually spiked higher. But the second piece of data, which was another confirmation of a slowdown in the economy, this is when the markets went to what I said before, risk off or market fear. They're both the same thing. When we get that fear in the market, you're going to get tech stocks, which is a risky asset, like NASDAQ, it's going to sell off. You can go to any time we had fear in the market, NASDAQ is going to drop. This was just an opportunity or a reason rather where economic data and the recessionary fears is what caused this drop here. How are you actually going to capitalize on that opportunity? Let's take it to the charts and I'll break it down. This economic data right here, this is fundamental analysis, right? That's what economic data is. And then the recessionary fears, that's market sentiment. So now that I know that I'm going to be looking for NASDAQ downside because it's going to go down when there's market fear, all we need to do is take a look at technical analysis. So if we take our zones, we mark up our charts here, all we need to do, or all you need to do, is find that area we are comfortable looking for sells. If I zoom in on NAS here, and I go to the lower time frame where I want to take some entries, or where you want to take some entries, all you're going to do is take a look at candle price action. After we get that data, take a look at the time at the bottom of this chart. 10 o'clock Eastern time. As soon as the data came out, NASDAQ immediately dropped. All you need to do is wait for a break of that support, and there's your entry with stops above the previous highs. So this is the entry, and then you can see how it played out. If I was to just play out just a couple candles for the rest of the day, this happened for 3-4 days really. But this is market fear, recessionary fears, using technical analysis to take our entries based on fundamental analysis, which once again is the economic data that caused the market fear. All we're doing is waiting for technical entries, waiting for these confirmations to take those sells. If NASDAQ were to continue not to break this and push higher, but my bias was market fear, I'm not taking sells, right? I still need to see confirmations in order to take my entries. All of this stuff, all this economic data, all of this sentiment analysis gives me a bias. But my actual entry confirmation comes from seeing price action and technical analysis giving me a reason to take an entry. Now, this is something that's already happened, but how do you know to take advantage of something like this if it were to happen again? Now, where do you stay on top of the markets, the headlines, the news, the data, everything that we just talked about? A professional trader or somebody like myself, I use a news terminal. You can see the screen behind me. That's called a Reuters news terminal. It's pretty pricey, and if you don't have means to get one, there are free resources that you can look at. You would basically just want to go online and look up an economic calendar, and you can pay attention to the data coming out every single day. The problem with them is there's a delay. They're not going to be as accurate as something like a news terminal would be, but you can still get maybe 70% of the information. When it comes to like news headlines, this is even more difficult if you have a free resource because there is even more of a delay. A lot of times you're going to see headlines come out when the news is talking about it, like mainstream media. I saw the headline like 4 hours ago, and the market saw the headlines 4 hours ago. So the problem is if you see a headline, in order to catch the opportunity, it's going to be a little difficult to ride the wave of the markets because the markets have already moved. I offer real-time news to my private community, and I'm not saying that's the only place you can find it, but make sure that if you look for real-time news, you're getting it from a trusted and reliable source. Technical analysis is important, right? But you need to have the information feeding into you, which drives technical analysis. So I need my technicals to take the entries, but I want the news, the data, the sentiment, the fundamentals in order to understand the direction or capitalize on the opportunities when they come. Because if you're not on top of the markets, you're going to miss those technical entries. So I hope this information was helpful to you guys. If you have any questions, just put them in the comments below. Make sure you like and subscribe if you want to see any more market breakdowns. I'll see you guys in the next video.